All right, good afternoon, everybody. Event Trader here. Going to be joined by Brett Manning, Chart Trader. Brett, you there?
Yep. How you doing?
I'm doing good. How's the day treating you today?
Pretty good. How about you?
Okay, that's good. Any things sticking out to you early on in the trading week here?
No, I mean just a continued kind of grind higher. I thought the hold of support this morning was really interesting. The NASDAQ short that I had on, I really I'd gotten so far in my mind about just, the orders were in to start taking profits under 78.20. It was just, there was no way to me that level was going to hold, and it just sat there and piled up the orders and then turned around and sprinted higher. So it's an interesting signal.
All right, let me ask you a quick question to start off, and I know we didn't really talk about this, but I have every confidence that you can think quickly on your feet, Brett, so I'm going to toss it at you. We're getting towards the month end. This is obviously a flow show here. You've talked a lot about portfolio managers that are afraid of underperforming their benchmarks. Obviously, they'll have a monthly benchmark as well. It's not a quarter end, but it is a month end. Do you see that impacting our movement over the next 2-3 days?
I really probably don't. I don't think that this is a market situation where you've got a lot of pressure from clients to, where you start losing assets. Usually that's a more higher volatility situation. I think that the benchmark comparisons are going to really become an important factor as we get down into like the Q4 stretch, where people are going to be thinking in terms of, how they're going to have those conversations around the holidays. As far as bonuses and, how much capital they're going to be managing the following year, I don't know if investors are really getting ready to pull assets out based on monthly comparisons at this point in the year. So I don't know if that's really going to be spurring.
Well, I would think it would be more of a flow into it myself rather than pulling assets out.
Well, okay, I mean, wanting to get more involved in the market, but I guess
Right.
the idea of will a fund manager act differently based on knowledge of how far behind their benchmark they may be, I don't know if that's going to pressure them over the next 2 days.
Okay. All right. Now, fair enough. I was just trying to figure where your head was with this, but to bounce back to where we were last week, Brett, I think one of the key themes that we were talking about is that we were seeing certainly an upbeat tone in markets, but not an excessive optimism that was playing out in a lot of the sentiment data that you like to look at. We talked a lot about the difference of sentiment data versus market-driven sentiment data. I think was a pretty key theme. Now, on that front, have you seen any big changes?
So what I'm seeing right now is we've got kind of two different universes, and one is professionals and the other is retail. And we're starting to see, we're seeing professionals just as sort of lukewarm, tepid, underweight, based on flows, based on surveys that I've seen. Generally speaking, it's kind of like a sense of not really being overly excited about equities exposure right now among professionals, but we are starting to see some signs of retail investors getting a little bit more involved.
On the optimistic side.
Yeah, I mean, we had the first extreme that we've seen for quite some time in the robo ratio.
And I actually noticed that the Lobo put-call ratio slipped out of that excessive optimism this time. I know it's probably a couple points here and there isn't going to make a big difference in your world, but just in terms of crossing those barriers that we're watching here, it seemed like Robo and Lobo kind of flipped roles a little bit there.
Well, and it makes that exact point, right? I mean, you're talking about the difference between large traders and smaller retail accounts in terms of when they're starting to lever up. And I would imagine some of this is just kind of, folks sitting around and looking at how this earnings season is starting to turn out and starting to decide that they can buy a bunch of calls in a high growth name ahead of earnings and they're going to make money on it. I mean, I imagine that that's part of what we're seeing there. But yeah, so Robo has sort of officially transitioned into something that you might call kind of shallow extreme optimism. It's not really a rock solid reading. It's not, I don't look at it as a red flag at this point, but it's getting there. It's as, and no doubt if we continue to progress in the market, it will run its course. It will get to where people are all crowded in buying tons of calls. It happens, most every time. So that will be an important moment for this trend when we start to see more serious divergence there where we see smaller accounts really loaded up on calls, you're going to be in a little bit of you're going to be set up for at least some kind of correction or consolidation. We're getting there.
Right, and for the most part, I would say the overall grade it seems like for a lot of these, we're staying near excessive optimism, but we really haven't crossed that threshold yet. Would you say that's a fair takeaway?
I think that is. I mean, I think we're sort of like, we're flirting with excessive optimism in some of these particularly retail-focused measures, and we aren't really budging the big money. And so, I mean, we can transition. Maybe now is as good a time as ever to transition into the Barron's. They do a twice-yearly big money poll, and they just put out their spring edition over the weekend where they're interviewing really, really large fund managers about what their thoughts on the market. And I thought that it mostly reflected this same kind of concept, that they came in at under 50% bullish for the first time since 2016, and 70% of them say that they're actively transitioning into cash. So there was that same kind of theme. I thought one thing that stood out to me, and we talked about this earlier today, and I put it in my notes as well, I thought it was a little bit absurd to suggest that you have unusual levels of outperformance this year. I would think that that's a very dubious suggestion. In a year where you've got people who, across all measures, suggest the fund managers have been generally more underweight than usual, and even in the results of this poll, it was a sense of maybe a little more underweight than usual, and at the same time, you've got the market screaming higher for the first 4 months, nearly setting like a record pace in terms of performance. I don't really see how you're going to end up with an anomalous number of fund managers outperforming the market when all of those factors are combined. So it kind of makes me a little hesitant to accept everything I see in that poll. And I think Barron's does a good job with it. I'm just not sure that the folks who are responding are necessarily wanting to put something out there in a publication like that would reflect a lack of performance for the type of audience that they're going to get. And obviously they're probably would prefer to get that particular audience, the so-called investor class, to be more interested in putting their money in large funds. So I'm not so sure that I take everything at face value in that survey. But what there is a penchant for cash, slightly less bullish than typical, and slightly less exposed maybe than typical. So I think that kind of is another confirming factor that you've got this kind of professional side of the market that's been really kind of not grabbing this rally by the horns and thinking that it's the greatest thing ever. But we are starting to see that retail shift a bit.
Yeah, I'd be curious, too, to take a look at the, I'm assuming the last Barron's, if it's twice a year, it came out in October. Would that be correct?
I believe that's correct, yes.
Because somebody asked me a great question today, and it was basically, if you had left the stock market 6 months ago, well, I guess technically 7 months ago, and came back, would you think anything had changed?
You may not think anything had changed, but something really, really important and huge has changed. And that is, in the intervening period, we went through a process of shaking all of the overripe fruit off the tree.
Yeah.
I mean, that's a big factor. That's a resetting process. We had the type of sentiment data and positioning data and changes that you see associated with major bear markets all just really quickly in the course of a couple months before the Fed kind of changed their tune. And I think that's really important because I think you've got a lot still, even still, right now, you have a lot of people who are long-term committed to, reasonably heavy equities exposure for the cycle who got shaken out. And according to all the data I see, they've had a difficult time embracing this trend and getting back in. And that means they're vulnerable to kind of capitulating into the market. And if you go back to, late September of last year, there was vulnerability in the market that was the opposite sort of situation. You had a lot of people who were very complacently involved and, not a lot of people who are committed to being long the equities market who weren't already basically as long as they typically would be. So the vulnerability has been shaken out of the market, and we've quickly sprung right back to the same price level.
All right, as somebody who loves to follow sentiment readings, what did you take away from that equities? The question was, are you a net buyer or net seller of the following assets? And the two that was sticking out to me was the equity answer, which had 83% buyers, 17% sellers, and then commodities too, with the 33 buyers, 67 sellers. And gold as well, 36 buyers, 64 sellers. Because I know you've been trading oil a little bit more recently, and you got into that gold long, and then equities in general, obviously, with the indices. Is there anything that you were taking away from those answers to that particular question?
So my understanding is this poll is mostly targeting equity-only, long-only fund managers. And I think that makes it a little different from something like the fund manager survey put out by B of A. So I think these guys are pretty much big, long-only equity managers. And I think that they're always going to be at 80%. They would prefer to be a buyer or seller of equities until they're not. And again, this is where I kind of, and again, I've got nothing against Barron's on this one. I'm not suggesting anything against Barron's. I can imagine, some of these are huge funds who are responding. And they're knowing that this is going out to a readership that is possibly their perfect target readership in terms of who they would want to advertise the fund management industry to, generally speaking. And so putting out a message that says we're net sellers of equities is not going to do a whole lot to inspire net flows of assets into the industry. So I think a lot of the answers in this survey kind of need to be passed through that filter of, what does the PR department say about your fund manager saying this? Because they know that the end result is going to be a product. And it's going to be in an issue of Barron's, and there's a lot of people that are going to read it who may be currently managing their own finances and maybe, would be a nice sale to get to put some assets into the fund management industry in general. So I think that just, it's interesting to see. That's why I take the 49% bullish as more important than that, because I think that it takes a lot to get these guys to say under 50%. As far as whether or not the market's going to go up over the next year, because that's the equation. Or do they want to advertise that to the world, that the so-called experts think that there's maybe less than a 50% chance that the market's going to go up over the next year? That's not a great message for the fund management industry in general. And so I think that seeing that shows probably they're more bearish than it's really being let on here. And I would also say that, as I said earlier, I'm not so sure that I take that performance relative to the benchmark number as being altogether, particularly reasonable given the context. But I think a lot, that's, this survey is maybe a little less useful, but maybe if you pass it through that filter in your mind, you can still get something out of it. But I would say that, for long-only, equity-only fund managers, most likely they're not going to be, really interested that much in exposure in gold or commodities.
Were you intrigued by the answers for number 13 for what the next move the Fed should be? And just to pass it along to people, they had 83% said that the Fed should not resume interest rate hikes. It's not resume interest rate hikes. 88% said that they should not lower rates. So obviously they are, it would seem fund managers are happy with where rates are right now.
Goldilocks, it's not too hot, not too cold.
64% said that the Fed should continue to shrink the balance sheet further. And then 92% said the Fed should not resume quantitative easing. So really no surprises there from my take, Brett. I know one of the things that you pointed out last week, though, was the surprise, and I don't see this happening, but we'll get into this a little bit more, and certainly more Wednesday when we do a little bit of a Fed preview. But do you see, were you surprised at the rate cut that we're starting to see in the September Fed meeting now?
Yeah, I think it's really, it suggests that there's a template for thinking about this situation that's not typical. And again, the way that I put it in our strategy meeting on Friday, there's an interesting level of the kind of will toward proactivity this cycle that I saw somebody put a note out, something that maybe the template that they're going by is something like what we saw in 95, 96. Of kind of trying to engineer a sort of soft landing situation where you get out in front of potential risks, and they've got the scapegoat of really low inflation in the first quarter to kind of allow them to get that message out there. But I don't think it's the type of rate cut you see. If one happens in September, I don't think that it's the type of rate cut that you typically see being the first rate cut of a cut cycle, which is usually in response to a dramatic and sudden awareness of a sharp deterioration in the cycle.
Yeah, I see inflation as being really the key concern for a lot of these, and I think we've seen it. I know one of the things that we're seeing in the Bank of America flow data was the rise in risk assets has led to a rise led by deflation winners is what we're seeing. A lot of moves into credit, tech, and the U.S. all likely funded via profit-taking in emerging markets, the U.S. dollar appreciation, and signaled the easing of global financial conditions. I thought that was one of the more interesting things I was seeing. Now, you, of course, are taking that gold play, which certainly wouldn't be a deflationary winner, right? So what are some of the divergences you're seeing there that you like from gold that also maybe makes you think that, you know, perhaps the leaning on deflation could be a little too early right now? Is that how you would view it with your gold long?
Well, first of all, gold can win in a deflationary situation. It just depends on, you know, the degree to which the deflationary situation inspires that sense of, hey, we're in uncharted territory. And disinflationary growth is probably the worst environment for gold. And if we continue to see increasing growth and inflation, but low inflation, but stable inflation, maybe ticking up slightly, you know, that would be technically the worst environment for gold, but that does not mean necessarily that gold can't win in that environment. If people want to move into gold, gold's personality changes just based on, you can come up with a different 100 different versions of a gold rally. You know, it happens in lots of different situations. I'm in it because of a long-term technical setup matched with exposure trends that suggest to me that exposure is low and generally rising, and we're seeing people wanting to hedge themselves against the potential for cycle end over the next, say, 12 to 24 months in a situation where if we start to move into an out-and-out recession, and we're already sitting on, you know, $1 trillion deficits, and those maybe in a recession situation need to move up to $2 trillion plus deficits, and we don't have any ability to use fiscal stimulus, and it all goes on to the central bank, we get pretty quickly to a sense of people feeling like, you know, we're really in uncharted waters. And whether or not that situation evolves, I think it's pretty clear based on the weekly chart that I see in gold, that there is a consortium of people managing large amounts of money who want to gradually trickle themselves into a situation where they're hedged for at least, you know, some percentage chance that we end up facing a scenario like that over the next year or two. And the move in gold really comes in front of that. You know, it's as they're trying to move in, just tiptoeing in more and more into something that would probably be a nice sort of island of safety in a situation like that. So I think that's what I'm seeing there as the trade, is really just trading the weekly chart breakout as we're starting to see those money flows come in. But yeah, I mean, if you just look at it strictly logically, if we see disinflationary growth, you know, endlessly on the horizon, then one would think traditionally it's not the perfect environment for gold.
What would you think the biggest threat is to your gold trade? Like, if you start seeing inflation numbers, technical, okay.
Yeah,
So
I mean, if it just starts showing me something different, this resistance level at 1300 is just a multi-year, you know, secular bear market resistance point off of the highs that we saw in, 2011. I mean, that would be, you know, we'd melt down off of 2011 highs into 2014 or whatever. We bounce up. We form this kind of sideways resistance point, and we just hit it again, and we start to roll over. So if I move through essentially the sloped support line across the weekly chart triangle, if it just breaks down below that, then, you know, forget about it. So I think that it's just there's so little that you can say with gold that really necessarily is hinged to any kind of genuine fundamentals. It's psychological at every point. And, you know, I mean, what's the price of gold? There's no economic justification for the price of gold. It could be $2 an ounce. It could be $2,000 an ounce. It could be $2 million an ounce. They're all just sort of arbitrary at that point. There's no real way to tie it down. So, you know, it really is going to do what it wants to do. And I believe that it's got a psychological backdrop right now where people will see it as maybe something that allows them to have, I mean, if you're managing vast amounts of capital, and you don't know what you would do if we rolled into a recession and saw $2.5 trillion deficits and the Fed trying to come up with something new because quantitative easing seems to be played out, then you don't know what's going to come next. And gold's kind of that point where you'll see people crowd into it a little bit under those sorts of conditions. So I think that that's probably, you know, that's the reason that I'm there, and that's either going to happen as far as money flows, or it's not, and I think that we find out based on how it acts around key levels. Right now, I'm seeing the right sort of thing. We got the dollar breakout. It wasn't able to significantly roll over. And at the same time, if you look at the CFTC data over the past week, it's actually, we saw on that test and break of 1275, we saw a massive dive in net spec long interest among large speculators. So that's where I want it to be. It's under 40,000 now. So that's a good spot.
This is for the dollar?
For gold.
Gold, okay.
Yeah, gold dove in terms of its net spec long, large speculator interest dramatically over the last 2 weeks, inside of a consolidation where it's basically gone sideways. So if those people just move back in, up it goes.
Yeah, I was seeing something too that in the Bank of America data that gold for the asset classes that they were tracking was the worst performer as well too, which is something that I'm sure you like to see as well, seeing as you're obviously just getting in it now, kind of getting in it at the lows here.
Yeah, basically, right? And yet it is up tremendously from its lows of last year, and in what looks to me like it's above its 200-day moving average, and it's basically in some form of an upward trend over the last roughly year. So that's, perfect.
Okay. Let me transition a little bit here into one of the things that you mentioned in the briefing in our strategy minutes meeting was the strength in credit. And I'm just curious if you've been following any of these credit, the corporate bond market ETFs. You were talking about the search for yield and people running into some of this corporate debt. Have you looked at these three ETFs lately, the LQD, the JNK, and the HYG?
Yeah, absolutely. And I think, just moreover, I think that the idea is we've seen one anomalous data point in all of this as far as looking at where institutional money flows have been and institutional sentiment. The one odd little standout data point that I've come across over the last few weeks is that leverage in general in hedge funds is particularly high right now. And yet exposure and correlation between the HFRX and the SPX is very, very low. And so you add those two things together, and I think you've got a lot of people looking for seemingly safe ideas, one being, hey, no inflation anymore, you can get into credit instruments now. You've got growth without inflation, so you can get into a squeezing of the spread between, say, junk bond rates and sovereign rates. That's that spread closure there. You've got buffering against higher rates by the low inflation, and then you've got 3.2% GDP, et cetera, et cetera. So you can really kind of move into those, and I think that's where the leverage is going.
Yeah.
If you do that at 20-1 on your capital, the returns you can get, you can outperform the S&P. Maybe that's where these guys are getting it. But, I think that that's the strategy that's been in play, I think, for hedge fund world so far this year. It's not buying stocks.
You think this will lead to a lot more issuance of debt by corporations?
I mean, it makes a lot of sense to me because they've already got some strains. So
it's pretty interesting too, because for the last few years we've been talking about the amount of issuance that's coming out in the corporate debt world. Really starting probably next year and through 2022. There's definitely there's been a lot of talk about it. So it's interesting to see how much demand is out there, and I wonder how much especially since it looks like we're on hold from interest rates, how much that's going to push companies to take advantage of that and try to issue more debt a little bit faster than one would have expected.
Yeah,
do you think that plays into the overall cycle?
I think that it could. I think that it gives us maybe an extension,
Yeah.
If this was a problem before, and I suppose this is just one of the ramifications of the Fed going on pause, essentially, and maybe markets starting to price in the possibility of a cut and us seeing a lower inflation level. It maybe gives us a situation where, hey, maybe there was something that was going to be wrong, but once you put it in terms where you've got this aggressive financial speculation and leverage moving into that exact area of the market, it allows for people to kind of get a little healthier in terms of balance sheets. And then extend time frames and duration and everything else, and maybe just kind of find the terms, and that I would suppose that could just kind of extend the process. I don't know whether it leads to a bigger bang at some point though.
Yeah, and one of the things that we're seeing from the Bank of America report too, of course, was that it had the biggest inflow in government bonds in 3 months, and also that high yield and emerging market debt. We're actually seeing an outflow. This was the first since January 2nd. So I'm trying to
Sorry, say that again.
High yield and emerging market debt outflows saw outflows for the first time since January 2nd. So I was a little surprised to see the high yield outflow, not so much the emerging market debt outflow, but I definitely think it's going to be interesting to see how companies are working their balance sheets moving.
Now, what I see for the last B of A data point I have shows inflows of $109 billion to investment grade, high yield, and emerging market debt.
$1.9 billion I've got for inflows in government bonds. Yeah.
No, but I see inflows to investment grade, high yield, and emerging market debt of $109 billion.
Okay, I'll have to double check my numbers. I thought I was seeing an outflow from them.
I haven't. Yeah. So unless one of the two of us is wrong. So
yeah,
I don't know.
Yeah. I'll go back and check that. I'll double check and we'll chat offline and make sure we get the right data out, and I'll post it to the site. But with the U.S. corporations, one of the things that was bouncing out to me too, and I thought it was an interesting aspect, and I'd be curious as we're looking for flow data as to what your thoughts were. But there's a lot of talk about corporate stock buybacks. There's about 5.1 trillion that's currently happened, and one of is up 22% year over year. This would be for the first quarter data. One of the things that I thought was extremely interesting was to talk about, in 2020, we've certainly heard a lot of chatter from the Democrats about looking to put in a law that would force banks or force companies to basically go to the government in order to get stock buybacks approved. The idea being that it's not a proper use of investment money here. So it seems to me what we're seeing is a lot of pull forward on some of these buybacks,
which sounds to be like a disaster in the making.
A disaster, exactly. That's what I'm talking about. But it's funny because we've talked about who's involved in this market, and there certainly seems to be the theory that the retail trader and a lot of portfolio managers are caught on the sidelines. We always are talking about how there's money on the sidelines that needs to be put to work. And, that has me wondering how much of this rally has been a pull forward on stock buybacks. And I was just curious if you had any thoughts on that.
Yeah, no, I do. I don't know how to disentangle those ideas, but let's just go with first of all, let's consider the possibility that this is a face value assertion of reality and that it's correct. Let's say that the sort of missing piece of how we're seeing this type of rally with net outflows everywhere and a tepid, for the most part, and for most of this time, tepid response by retail investors. Let's just say that the answer is that it's been fueled by corporations buying back stock, and that the reason is because they believe that they're at risk of no longer being able to do so before too much longer, and therefore, they need to get all that buyback in now. If that's the situation, then, and if that isn't really the scenario that we're in, then that sounds to me like, like on a very large time frame, just an amazing cycle short setting up. So I don't, if you've got people committed to being on the sidelines based on data and the risk of cycle turn, and this market sort of being propped up on this pull forward of buybacks, one would think that if that's true, and if people start to understand that that's true, then you'll have larger money even less likely to want to get involved when they feel like that process has passed. The tailwind is now and they're missing it, and then the wind changes direction after, let's say, some new legislation that reduces the ability to have a buyback. Then that money's even less likely to come in off the sidelines, I would think. Does that make sense?
Yeah, no, that totally makes sense.
So I mean, that's a particularly dark scenario for the market, I would say.
Because you're just basically outpricing your equities for the retail trader and a lot of portfolio managers too, I suppose.
Yeah, and you're not front running a crowd that's moving with you. I mean, or the crowd's not front running you. That would be right. The way that this turns into a bubble is if everybody knew that in advance and people were piling in left and right and able to sell to the greater fool known as corporations doing the buybacks. Yeah. But if you don't have that tailwind, it seems less likely that you're going to have that aggressive rush of capital off the sidelines, especially if you know in advance that the rules just changed and this same buyer, the thing that's promoting this rally right now, is no longer going to be there. You want to know that somebody's got your back. So I mean, I don't know. That scenario depends.
Corporate put, if you will, right?
Yeah, I mean, yeah, exactly right. So I suppose that this scenario entails, that we have to, it has to be it has to actually happen, that legislation. Otherwise, I suppose that they've got a rate of buying that would slow down at a certain period, but you'd have to, for this sort of strange lack of a corporate put doomsday scenario for the market to play out, you'd have to actually get the legislation to pass. That limits it. So
right. And obviously this is still all pie in the sky stuff, but I did find it to be an interesting theory. I mean, definitely seems like there's a large threshold to get that stock buyback bill passed, but just found it interesting considering those buybacks are up 22% year over year. So another thing that was sticking out to me was from the sentiment trader data was that soft versus hard economic surprise number, Brett. It's been sliding the past 2 weeks, and it's now moved under excessive optimism. To be perfectly honest, I was surprised that we were above excessive optimism given some of the data points. Quick question for you. Does this only cover U.S. data? Do you know offhand?
That's a spectacular question.
Okay.
I don't know the answer to that question.
Okay.
I'm going to guess that it does. I think that most of the economic data that is put into these measures considers to be, for the United States market, and Citi I know does globally and by sector and by country. I think that this is probably just the United States. I think we assume that it is just the United States, and I think the way that measure works is essentially that it's actually sort of a good thing to see the movement in the direction that we're starting to see, which means the hard data is starting to take up more of the slack rather than the soft data.
Okay, yeah, because basically what it's leading me into is since our last chat, there's been a few things out on sentiment reads and just potential market movement events. So I was curious as your take on them. Number one, starting with the German IFO business survey. I don't know if you saw that, but I mean, basically they were saying that the economy in Germany was continuing to deteriorate, and I'm just curious as to your thoughts on how you're viewing Germany right now, and in terms of where you see it as a global linchpin for the markets.
Well, I mean, I think that, everything to me is about there's a reality and then there's where we are as far as the degree to which we perceive that reality. And I would say that, as I said in our strategy meeting on Friday, the thing that everybody knows the most out of anything right now, out of any fact on Wall Street, the idea that Europe sucks and the United States is great is probably the most popularly understood idea. So I think that it would be more interesting for me to see signs that things are suddenly, starting to go better in Europe than people were expecting. I think that could cause a lot of important gyrations in the market. Maybe putting a false breakout tag on what we're seeing in the dollar, maybe ripping a squeeze in the euro. I mean, I don't know if these things are going to happen, but that's certainly the thing that would be what people aren't prepared for in terms of their positioning. Right now, I think everybody is extremely prepared for Europe to do poorly, for Germany to do poorly, and for the United States to just continue to be sort of the cleanest shirt in the laundry.
Okay. And basically, Brett, I'm running through just a couple things that happened last week, and it's going to lead up to a question of this week. The second the second piece is the Bank of Japan commentary. I don't think anything was out of the ordinary there. Just to recap, they basically put a date on when their inflation target could be hit. I guess we could both laugh at that one because we know that's going to be adjusted. But the idea was that got them a little bit more dovish. Did you see anything from the Bank of Japan that would have changed anything in yen positioning? We've talked a lot about the carry trade there, given there is an unlikelihood of them moving rates. Would anything from BOJ stick out to you?
I mean, it just seems like, just another example of them sort of saying, you've got this two tensions, which one is we need to get inflation, we need to get inflation, we need to get inflation, but the other is, we're hurting the banks, we're hurting the banks, we're hurting the banks. And it's, kind of this struggle, and it feels to me like by, they're putting they're extending the target, I think, right, to when they believe that they'll hit their inflation level, but it's just sort of like, it's just I think that the way that works for the Bank of Japan is basically sometimes it gets tangible. Sometimes they actually start to think they might ever get there, and so they start to put a closer date on it, and then, oh no, they're not going to get there ever, and then the date just goes further out. And it's just kind of like a sense of, well, we're not going to get there. But at the same time, they did not, they don't seem to be increasing stimulus, and they actually widened, I think, the range in several important ways in terms of their buying, so they could actually be allowing some of the stimulus to go off the table, and they are actually shrinking their balance sheet a little bit. So I wonder if maybe they're a little more concerned than they'd let on as far as the ability of banks to be viable in the interest rate environment that they've created.
Yeah, and certainly the economic data that we've been seeing from Japan has been pretty weak. Q1 GDP in the U.S., big beat coming in at 3.2%. In talking with Pat O'Hare, he was quick to note that about 0.7% of that boost was from inventory, so that needs to be taken noted. How do you see Q1 GDP impacting sentiment, if at all?
So I got a note from somebody who follows David Rosenberg, and I know that he can be particularly bearish on a lot of things at a lot of times. But the note, and I don't know, we maybe want to check on this, but the note said that if you remove things that never go down, like food, healthcare, or rent, the economy contracted in Q1. And so the half of the economy that is actually sensitive to the vagaries of the economic cycle,
discretionary, and
it contracted 2% in Q1, and it was the lowest level of nominal GDP we've seen in many years, apparently. So so once you basically take out the effects of, or would you add in the effects of inflation to all GDP numbers and look nominal across the board, it was apparently a collapse. So take that for what you will, but it's kind of interesting to note that that we saw a contraction in.
Yeah, I'd be curious if something like that takes into account gasoline prices on the rise, which obviously takes up a greater part of the pocketbook and stuff as well, therefore hurting discretionary spending. But for me, Q1 GDP was a bit of fluff, and the second that number comes out, it's old 2 minutes later.
Yeah, yeah, exactly.
So I didn't see it as, but I was just curious if you had any thoughts on the sentiment side of it. And then China industrial profits came out last night, showing a big bounce back from January and February. Chinese data, and I'm going to talk to you real quick about some of the commentary we've seen from some of the earnings. And the industrial commentary that we've seen around China has really just been confusing more than anything. Do you feel like you got a good beat on where China is, or is that like just a big head scratcher for you right now?
I think that where they are is in a good position to do more stimulus than necessary and to leave it on longer than necessary. And, I don't really know what's underneath the surface there because it's really difficult to get what you can necessarily believe for sure is accurate information about how things are going. So, I know that I would imagine that they may be doing slightly better than they're projecting, but it's going to be an interesting process of discovery, I guess, step by step.
And then, of course, we've got earnings, a couple of notable ones. 3M, very cautious on China. Intel, cautious on China. A little bit pullback on some of the commentary we saw in the chip space with Texas Instruments as well. Amazon, strong quarter, but we're starting to see people question their growth rate abilities. The earnings collectively as a whole, did you see any sort of shift in sentiment over the last week there?
In general, obviously, we talked about it on Friday, and you'd have a better handle on this than I do, but the sense that this is not just better than feared, but it's a bit surprising how things are going. Now, I suppose there were some stumbles around semis and what we saw through 3M and some of the commentary on China. But generally speaking, it's what doesn't suggest that Rosenberg read on Q1 GDP really as being necessarily something you want to take to the bank. So, I think we just continue to be in a situation where the data is doing better than people would think, and we've got an oddly dovish Fed expected to get oddly even more dovish. We've got a lot of capital on the sidelines, and it's sort of like something has to give. Either we need to start seeing this rush of surprisingly bad data, or we're going to start to see normalization of exposure among professional money managers, and it's really just kind of this interesting process of that coming to a head.
Okay, now collectively, Brett, with German IFO Bank of Japan, Q1 GDP, China industrial earnings. So this week we get the fresh PMI data. Now, granted, we've already gotten some of the preliminary numbers, and we've got the Fed. So how do you see the recent round of data and the current market situation and the move into watching the PMI? What would you be watching for in terms of potential changes in sentiment, or what do you see as the most important aspect of these PMI numbers coming out?
Well, I just think the trend is, that's another signal of, we talk about Turtle Beach, with the turtles coming out of their shells, and it goes across markets and certainly into the economy and individual economic agents making decisions in households and banks and everything else. And PMI is a great read on, what people are expecting as far as what's sitting ahead. And if we start to see, that's the type of shift. If we start to see a pickup in PMIs, a positive direction, I don't see how you continue to get this same level of lack of participation in terms of the equities markets for large money managers. I think the PMI is an interesting point there, especially if at the same time, if we talk about like a perfect storm, if we get the Fed coming out and, we move back expectations even further. So we've seen all year the Fed chasing the Fed funds futures lower, right, in terms of expectations of what they're going to be doing. If we see another move like that, if we see some commentary that suggests that it's starting to ratify, and I guess the way to see it is if we see even greater expectations in the Fed funds futures market by the end of this week for a rate cut in September, then the market will be judging that the Fed has moved further in that direction. And if we see that paired with increasing expectations in terms of PMI numbers, in terms of economic performance, then that just seems like the perfect recipe to just launch a melt up into gear.
Yeah, no, I completely agree, particularly on the European side. And if we saw a little bit, South Korea would be another one of interest to me. They got that heavy semi-space, the weak Q1 GDP numbers. And, I think all of this has generally been known, but what we haven't seen is any really solid hints that the second half recovery is in place. So I'd be curious to see what South Korea's PMI comes back with. Now, how about with the Fed, Brett? What are you looking for? We'll get into a little bit more deeper depth on Wednesday ahead of the Fed meeting. Anything in the Fed that you see kind of upsetting the apple cart in sentiment?
It would be obviously if they came out more hawkish than expected.
Sure.
The market is not expecting that at all. So, who knows what's going to happen? It seems like that. I don't envision.
The last thing they want to do is upset the apple cart.
Yeah,
right?
they've created a risk now by the way that they're messaging. So I think there's always this interesting relationship between the Fed and the Fed funds futures. I think that they are willing and active participants in that relationship. I think you do not get 2 days away from a Fed announcement with something, painting a picture where they're feeling like they're going to upset that picture and they haven't given any kind of warning in advance. I think that's what Fed speak is all about. It's about messaging those expectations to prevent a sudden stark change in what people are expecting from policy. So I think that the fact we haven't seen, those little Fed speak moments over the last few weeks of just kind of hinting that, hey, the market's a little too complacent with policy expectations right now, something like that. We haven't seen it. So I would imagine there's no chance of a surprise there.
Yeah, and it's funny, too, because there's no chance of a surprise, and there's going to be an attempt of no chance of a miscommunication either, because after Powell speaks on that Friday, Brett, we've got, I think, 7 Fed speakers out that day.
So we're going to get the messaging down pat.
Yeah, exactly. So, all right, Brett, I'll tell you what, we're running a little bit long on time. I was going to see, is there anything that we've missed that you really wanted to cover? And then if it's cool with you, I was just going to run down and take a peek at some of those Barron stocks that they mentioned. I know you're usually a macro guy, but I do know the subs love to hear your thoughts on the occasion on equities. I figured we'd just take a quick rundown at some of those names.
Yeah, that's fine. Go for it.
Well, is there anything that we're missing that you really wanted to chat about first?
No, I think we've been pretty comprehensive.
Okay, let's take a look. So this is it was one of the polls from Barron's. I think it'll be fun just to run through. The question was simply, are you bullish or bearish about the following investments? First one up was GE, who reports tomorrow. I did the earnings preview for him. Please take a look when you get a chance. 37% bullish, 63% bearish. How do you see this playing into the stock, which is trading just below the 50-day moving average here?
Well, I mean, you can imagine it's an extremely liquid security with some of the largest fund managers in the world reporting that they think that it will go down, which means, that just sets us up for a squeeze possibility, I would say.
Completely agree. And again, I just find GE to be the most fascinating stock out there just from its corporate debt perspective too.
Yes.
Tesla, TSLA, 9% bullish, 91% bearish. Now, this is one that I'd been saying for people to lean on. I was thinking we could get down to that 180 level, but when I start seeing numbers like this...
Tell me who's left to sell. And that's the weird thing to say. I don't understand how this stock behaves. I didn't understand it when we saw the other day. It was so strange to me to see such an unequivocally bad report and to see the stock not immediately go down, but then several days later fall off the table. Like, that's so odd to me. But,
yeah, I didn't find it odd. I mean, there's just so many troubles there, but it's like you said, who's left to sell?
I would imagine that. The odd thing I'm saying is, I'm surprised it wasn't at 225 10 minutes after the report came out. That it took a week to get there. That there was this slow process of gradually accepting that it was a bad report. But then again, none of here's some of the largest fund managers in the world, and how much do you think they own of Tesla, right?
Yep.
None of it. So
none of it.
Where's that selling pressure going to come from?
Yeah, it's really is a retailer's dream, I suppose. Next up, Apple, who also reports tomorrow there after the close. They had 72% bullish, 28% bearish. So, again, who's left to buy? But it also doesn't seem like anybody's really all that interested in selling right here at the moment.
Yeah, it kind of doesn't work the same way in the opposite direction with some of these stocks because, it doesn't mean that they're going to sell. But there is, I suppose, the possibility that you get this narrative of, with Apple, you look at the possibility that they're in this process of this evolutionary change in terms of what they're going to be really seeing as their growth driver for the next 5 years. And usually, a large-scale evolutionary changes in major corporations don't necessarily go off without a hiccup, along the way. So I suppose that it's possible that there's some surprising news. Occasionally there is with Apple.
Right. Next up, reported last week, decent report, Facebook. Ripped up to that 200 level, obviously seen a little bit of resistance at that psych area, but making a nice bounce back today. Facebook had 31% bullish, 69% bearish. How do you interpret that?
Well, same way, a little bit like we talked about GE. Obviously, there's a difference there, in terms of what sort of industry we're talking about here and where growth possibilities are. But, Facebook's sort of like got a little bit of a monopoly, and as long as the demographics hold up, even if they've got some bad press from time to time, it doesn't necessarily mean that they're not going to still absolutely control the market that they control. I don't really see how that's going to be dented, and I suppose that if you've got this much bearishness on the stock, then it's probably somewhat safe.
Yeah, I would tend to agree with that. Next up, marijuana stocks. 39. They didn't have any specific ones, so I guess this will just go in as a grand ACB, CGC, Tilray. We'll just call it those three, MJ for the ETF. 39% bullish, 61% bearish.
So I'm going to go with this passed through the legal and PR department again, and not so much about marijuana as much as it is about high-risk securities and people wanting to say that they're particularly bullish on them. I think it falls right into the cryptocurrency thing as well, and it's about messaging to the
cryptocurrencies was the next one up with the 9 and 91, so we could cover that as a whole.
They're kind of both very speculative ideas, and that's not what we do here, so please give us your money.
No, I like that. I like that. And how do the cryptocurrencies? I mean, obviously, been on a steady march higher. How do you view them in terms of the deflationary story here?
Cryptocurrencies? I mean, I
Yeah.
don't know. Yeah, okay, we can pretend that there's a logic there, and maybe there is. I mean, cryptocurrencies in general, though, I think that I don't know. It's evolving into place. It's still
Yeah.
forming an identity, and it's still so early in the process. And maybe there is this gradual, long-term secular process where, I mean, as far as I'm concerned, what the cryptocurrency revolution is, if there is one, is about disrupting, I think more than anything, the legal profession, which is really, it's the idea that you can have trustless contracts and that you lose a whole need if these become smart contract, processes become really enmeshed in how we do all sorts of things in terms of contract law. It removes a whole massive side of the professional class in terms of being necessary. And I think that the degree to which we start to evolve into having lots of different cryptocurrencies that represent real value in the world because of their ability to disrupt or supplant those sorts of processes, if they really catch on and then go mainstream, that's probably at the base of a real bull market in the cryptocurrency space rather than just like, hey, Bitcoin's like gold. I think that it's finding different ways to create systems of token exchanges that disrupt different industries. So I don't know whether or not that's going to actually happen or work, but I would feel like that's like, I mean, I don't know if Bitcoin's ever going to have like that mainstream established kind of feel to it. It's got too much. There's just every major government around the world is going to be finding ways to, not allow that to happen.
Right.
So I don't know if you get past that.
Yeah. No, I would agree. All right, Brett. I think that's going to do it for us then. Do you got anything else to add?
No, I'm good.
All right. Well, if anybody's got any questions on anything, or if there's any aspect of the show that you're liking, we're still in that kind of discovery phase, so just trying to get everything settled here. So please feel free to write in with any ideas or any suggestions. We're more than open, and things that you like, things that you don't like, and we'll continue to hopefully provide you with the data that you need to go out there and understand how the market's trading right now. So, hey, Brett, as per usual, thank you very much, and I'm sure me and you will be back on Wednesday for a little preview of the Fed, right?
You got it.
All right, talk to you soon.
All right, take care.
Okay, you too. Bye-bye.